Ladies and gentlemen, please welcome Barbara B. Taylor, Director of the St. Louis Art Museum, Min Jung Kim.
Good morning, everyone, and welcome to the St. Louis Art Museum for a conversation with James Bullard, President and CEO of the Federal Reserve Bank of St. Louis, presented by Greater St. Louis, Inc. I am Min Jung Kim, the Barbara B. Taylor Director of the St. Louis Art Museum, and I'm so pleased to be with you this morning. It has been more than a year since you last gathered here, and in that time, I've also been able to see firsthand the work Greater St. Louis is doing to foster inclusive economic growth in our region. The St. Louis Art Museum is a proud partner in those efforts, and as a cultural institution that has offered free general admissions for more than a century and holds a diverse and growing collection of works donated by and for our community, the museum is proud to be STL made. It is noteworthy that you are also here this morning as we open our second ticketed exhibition of the year, Monet Mitchell, Painting the French Landscape, which is an exhibition that brings St. Louis to the forefront of international scholarship on these two artists, Claude Monet, a preeminent French impressionist, and Joan Mitchell, a leading abstract expressionist artist. This week, we've already welcomed a number of out-of-town guests coming to St. Louis, as we are the only museum in the United States where you can see this once-in-a-lifetime pairing of these two world-renowned artists. I hope you'll stop by to see the show afterwards or return with your families at another time. It is now my great pleasure to introduce a community leader, museum supporter, John Kemper, Chairman and Chief Executive Officer of Commerce Bank. John has been instrumental in the support of the Art Museum, particularly our fall exhibition called The Culture, Hip Hop, and Contemporary Art in the 21st Century. This exhibition has already been named by London-based art newspaper as one of the 12 must-see exhibitions in the world of 2023. We are thrilled to have the William T. Kemper Foundation as the presenting sponsor of this exhibition, and I look forward to welcome you to that show in August for another project that will truly be STL made. And with that, please welcome John Kemper.
Well, good morning, everyone. Min, thank you for that very generous introduction. And first off, I'd just like to say thank you, Min, for hosting us here today at the St. Louis Art Museum and for your work in sustaining and growing this institution's well-deserved reputation as a world-class museum. We are so fortunate to have this wonderful institution here. And Min, we are so fortunate to have you at the helm. I have to say, on a personal note, my wife Ashley was on the search committee that brought Min to St. Louis 18 months ago, I think, Min. And I can tell you, I can tell you that she was a slam dunk selection, and I found myself sort of hearing some of the back chatter and wondering, how can anyone live up to these glowing reviews that I've been hearing? And Min, I would just say that you've exceeded those high expectations in every way, so we couldn't be happier to have you here. So good morning, everyone. I'm glad to help welcome you to a very special event here for Greater St. Louis, Inc. We're sponsoring it today on behalf of the investors, among whom Commerce Bank is very glad to count itself. Commerce Bank is really proud to be STL made. This is where we live, this is where we work. It took me about 10 minutes to get to the museum this morning. And this year, in fact, we are celebrating our 50th anniversary of operating in St. Louis. And in just a month, we're moving into the new building, the Commerce Bank Tower, that we've just completed in Clayton. And I can speak, for both my family and for the bank when I tell you how committed we are to being part of this movement, to helping to steward this metro toward a vibrant, inclusive economy. And one way that we're doing that is through our active engagement with Greater St. Louis, Inc. It's been 2 years now, and in the 2 years that since GSL was formed, we've seen, I think, a new and healthy sense of optimism and a spirit of collaboration here that's given St. Louis a much-needed boost of energy and enthusiasm. And I can say, for Commerce that, as a member of the Executive Committee of the Chair's Council, we're seeing firsthand how the business community is coming together with a truly unified voice and I think an appropriately bold agenda for regional growth. It's also been a great benefit to be able to participate in events like today's, where we have a unique opportunity to hear from Jim Bullard, the President and CEO of the Federal Reserve Bank of St. Louis. And given the backdrop that we're all reading right now in news headlines and in the macroeconomy, I think this perspective could not come at a better time. Now, before President Bullard speaks, we will hear just briefly from Jason Hall, who's the CEO of Greater St. Louis, Inc., and is very well known to everyone in this room. Jason brings to his work both private and public sector experience. He served on Missouri Governor Jay Nixon's cabinet, where he led the Department of Economic Development, and the Missouri Technology Corporation, where he launched the state's venture capital fund for early stage companies. So Jason, I'm delighted to welcome you to the stage, and we're looking forward to the event today.
Appreciate it. All right, well, good morning, everyone. And John, thanks for your kind words and leadership at Greater St. Louis, Inc. and for this broader community. As John mentioned, you all formed Greater St. Louis, Inc. Just 2 years ago. And thanks to all of you, I think we're seeing the power of having the business community that is civic-minded, united with one voice, one agenda, and allowing our metro to compete more effectively as one. I think we should all be proud. St. Louis is resurgent. And that resurgence is being seen in historic wins that we as a community of civic-minded business leaders are putting together. I think we're showing as well, as John mentioned, this optimism and confidence coming out of the pandemic and the other disruptive global forces is real. Last year, there was 1 week where this region came together, going head-to-head with other cities in just 1 week, winning over $1 billion of capital investment from competitive projects around the world. And to put that in broader perspective by the numbers, earlier this month, St. Louis was named #1 in a big swath of the Midwest by the leading global corporate site selection trade publication for deals closed. We didn't seek that award. We did not buy that award. We earned it on what we all did together over the past 18 months. And that's the first time St. Louis has ever been #1 in that trade publication. Speaking of other firsts, I know many of us in this room have always said, we got to get St. Louis out there. We got to tell that story, and we got to do so with confidence. And one event seemed to capture our imagination more than others, and that was South by Southwest. We often talked about the need to put our innovation assets and the amazing things you all are doing up on stage, and GSL was proud to quarterback and get St. Louis accepted, not just once, but twice on the big global stage at South by Southwest. We led a delegation of over 50 St. Louisans from all stripes of the economy to come together and get our rightful stage up there with the other great innovators around the world. And I thought, we can walk and chew gum at the same time. During that same week, while St. Louisans were shining on the global stage, telling our innovation story, you saw, and all of us in this room participated in, an unprecedented level of pride, STL-made pride coming out on 314 Day this year. I've never seen anything like it. People that are often in conflict coming together to say, let's lean into the positives of St. Louis, and together we are stronger. So that is our focus, of course, altogether, is winning the decade for this metro. It is a critical decade, and we must win. But we also need that to be grounded in the broader macroeconomic forces that impact the opportunities and the challenges that we need to overcome. And that is why it is so terrific to be here today, again, with St. Louis Federal Reserve President Jim Bullard, a member of GSL's Executive Committee of the Chair's Council, our most generous civic investors. President Bullard helps shape the direction of U.S. monetary policy while overseeing the Federal Reserve's 8th District, which includes branches in Little Rock, Louisville, and Memphis. He's an honorary professor of economics at Washington University here in St. Louis. And this is just the second year of this forum with Jim. And Last year, I was sort of informally calling Jim's remarks the shot heard round the world. And you may recall, as we were in this room gathered with Jim, it was the first time where Jim's comments were quite prescient, actually, that we were going to be confronting an inflationary set of pressures that we hadn't seen before, and was calling for rate hikes to tame in that inflation, all playing out just days after the invasion in Ukraine. Forces have been disruptive, but one thing is clear: Jim was correct. His insights shaped global policy, and I can't wait to hear what he says today. All of that should be a reminder as we gather for this that St. Louis is a leading global financial services market with an impressive roster of employers, innovators, and thought leaders in this sector. And we should be proud of that because we are globally excellent. After President Bullard speaks, we are going to have this fireside chat, and we're very excited to welcome Tim Welsh, the Vice Chair of Consumer and Business Banking for U.S. Bancorp. They are a founding member at the executive level with Greater St. Louis, Inc. Tim is also very involved in his own community in Minneapolis, where he chairs Greater MSP, which is the Greater St. Louis, Inc. Organization in Minneapolis, St. Paul Metro. And Tim and I actually got a chance to meet each other in Chicago last year. We're part of this national network, kind of the unorganization of regions that are really getting their act together coming out of COVID and want to share best practices, replicate them, and get them in practice really quick. He is so smart, he is terrific, and deeply committed to his community. So let me thank St. Louis Art Museum President Min-Jung Kim for hosting us, all of you for being here, and President Bullard for helping share his insights here first. This is the first set of public comments coming out of the blackout with the Federal Reserve. So stay tuned. It is going to be exciting, and we're going to welcome President Jim Bullard.
Thank you.
Thanks, Jim.
Well, good morning, and thanks very much for the kind introduction. I was talking with John Kemper before we started, and he was reminding me that last year we had the Russia-Ukraine war, and this year we have a lot of financial stress, so maybe we won't do this next year. But I'm happy to be here, and this is a great event. It's great to see you all out here today. And I am going to just give you my take on the current macroeconomic situation, which has evolved a lot over the last 10 or 14 days or so. And I'll hit on a lot of the themes I like to hit on in thinking about the macroeconomy right now. So we do have financial stress over the last 2 weeks that came as a surprise. And I'll talk about that. So this is just very, in macroeconomic terms, we usually think in terms of quarters, but this just happened in about 2 weeks here. But I will say and emphasize that the macroprudential policy response has been swift and appropriate, and I think it will contain the stress, and so I'll talk about that. Meanwhile, the real economy has been stronger than expected during the first quarter of 2023, and inflation remains too high. So I'll review the data on that, but basically we've been surprised to the upside on the macroeconomy as we've come into 2023 here. Now the first quarter is almost over, so it looks like a stronger first quarter than expected. I will also say that during 2022, we did a front-loaded strategy on monetary policy, a lot of interest rate hikes during 2022, designed to keep inflation expectations in check and designed to bring inflation back to target relatively quickly in macroeconomic terms. I think that's going to be helpful in our disinflationary efforts during 2023, so we'll look at that. And then finally, I think the overall message here is that we do have macroprudential policy tools which have been deployed. They can contain financial stress, while appropriate monetary policy can continue to put downward pressure on inflation. So we do have tools to do both. We're deploying those effectively, and I think we'll be successful. So financial stress has returned, and so I'll just review some of the main things that have happened. We had 2 U.S. banks with crypto-related strategies, Signature Bank in New York and Silvergate Capital in California. They've closed after the failure of FTX, the cryptocurrency exchange, late last year. So the FTX case is in criminal court, and that trial will be later this year. But they were considered one of the better players in the crypto market, and obviously they've stumbled badly here late last year. The banks that were trying to cater to the crypto world, Signature and Silvergate, they had strategies that probably weren't going to be very effective following FTX, and so they're now out of business. So that's one thing that has happened just in the last 2 weeks here. We've also had the California-based Silicon Valley Bank, SVB, suffering a rapid run on deposits, and that has been closed by the FDIC as well. SVB had a very unusual strategy from the point of view of other banks, which are far more conservative than they were. They're situated right in the middle of Silicon Valley. They took on a lot of deposits, tens of billions of dollars of deposits during the pandemic as Silicon Valley boomed during the pandemic. And a lot of those deposits were uninsured, upwards of 95% according to media reports. That's very, very unusual in the world of banking, that you would have those kinds of circumstances all at once. They did suffer a rapid run on their deposits, and now they're closed down. Equity holders were wiped out. Depositors were made whole in the end. So this is, from a business standpoint, the people that put their money into the business have been wiped out, but the depositors were made whole. So that, I think, is a very unusual case, and I think you'd be hard-pressed to find other banks that had the kind of situation that SVB had. Now, in Europe, we do have Credit Suisse, which is a very large bank, but also a bank that's been troubled, not just in the last few weeks here, but really over a decade or more. Their business has declined over time. They've been involved in court in various countries for things that they've been involved with. So they've had a lot of trouble in a lot of different ways. They are a wealth management business. They've been losing customers on that dimension. And the Swiss authorities did come in last weekend and say that, implement a plan to merge them with Union Bank Switzerland, UBS. So Switzerland just has the 2 very large banks. This is something I think that had been at least rumored to be on the table for a long time, and the Swiss authorities made the decision to go ahead and make this merger. The stock of UBS traded up following the deal, so I think markets are giving this, at least for now, a thumbs up, that the combined entity will be able to be successful, that UBS will be able to reorganize the assets in a way to have a strong business going forward. So that, I think, was also a swift response to financial stress and a logical outcome for that particular situation. Now, these developments have led to volatile trading in bank equities. Not surprising. Investors are certainly searching out where the value is in the banking industry. And that's showing up in increased measures of financial stress. None of that's surprising. But I do think that the response to the situation by regulatory authorities has been strong. I would just, before I get off this slide, I would just remind everyone that we're operating in a Dodd-Frank world, a world where we already went through a financial crisis during 2007 to 2009, and regulators have many, many more tools than they had at that time, or that had to be developed at that time. Those can be deployed now, and yesterday Secretary Yellen said, we're willing and able to do more if necessary as we go forward. So I think everyone needs to keep in mind that there are many tools, many macroprudential tools that could be deployed and could be deployed quickly if necessary. But this is just a rundown of what has happened. As I say, I think the response has been very good. So here's a killer chart for this talk, which I know you're always looking for when I'm giving a talk. This is different measures of financial stress, and I put them all on one chart so that because there are many measures of financial conditions and financial stress that are out there, these different indexes. If you're going to look at one, you might as well look at the very best one, the St. Louis Fed Financial Stress Index, which is on here in the blue. But just to convince you that we don't have a crazy measure, Bloomberg and another one are also on here. The DB, I guess, is also on here. And there are many others that could be put on here. And if you look at this carefully, the St. Louis Fed Financial Stress Index is on the left axis, so that one means financial stress is higher when the line is higher. And then the other two are on the right axis. They mean that financial conditions are tighter when the number is lower. So we put that upside down as negative numbers going up there on the right-hand side. But you can see that if you scale it appropriately, the indexes are measuring essentially the same thing. They're trying to measure ideas about credit spreads getting wider, volatility getting higher, market anticipation of problems reflected in market pricing becoming more acute. That's what these kinds of indexes are trying to measure. And I deliberately took this all the way back to 2008 on the horizontal axis so you can see the whole picture here, all the way up to the most recent readings, which would be this week, for most of these indexes. So they're either weekly or daily indexes. So you can see some big spikes here in this picture. One is in 2008. So that was the big crisis, and this financial stress was extremely high at that point. Then they all came down for a decade or more. The next spike that you see there, that's the pandemic, April, May of 2020. And I do think in April and May of 2020, there was serious questions being raised in financial markets whether we would re-enter a financial crisis at that time. And Chair Powell and working with the U.S. Treasury and sister regulatory agencies managed to avert that in the spring of 2020. And you can see at that point, the financial stress indexes and financial conditions indexes came all the way back down to zero. Zero kind of means normal times in this picture. So I think that was a great success story of the implementation of policy during the pandemic. Then we got even less financial stress after the pandemic, and then a little more volatility as you come out of the pandemic into 2022, where the Fed is raising rates a lot. And then we've circled the very last observation here. But the point of this picture is that, yes, financial stress is up. It's not zero anymore. It's higher. But it's not at the level that it was in April and May of 2020 as the pandemic was coming on. And it's certainly not at the level of 2008, 2009, way back on the left-hand part of this chart. So, yes, we had some unusual developments in banking. And certainly the SVB case was unusual. And yes, that has caused stress in financial markets. A lot of the reason that that line is up on the very right-hand part of the chart is the volatility of interest rates in recent days, but still not really anywhere near the level of the pandemic or of 2008, 2009. So I spent a lot of time on this chart, but I thought that was an interesting finding. Of course, you don't know quite what will happen going forward, but so far so good, and I do think that the response to the crisis so far has been appropriate. So again, this is hitting on some of the points I've already jumped ahead in my mind here, but the global financial crisis caused a rethink of macroprudential policy. It put a lot more tools on the table, not just here in the United States, but around the world. And so it was natural, as financial stress developed here, that we could employ some of the tools that were developed or first utilized at the time of 2007 to 2009 or during the pandemic, 2020, to limit the macroeconomic damage that might have otherwise occurred. And in particular in the US, the Fed worked with the US Treasury and other regulatory agencies to use 13.3 provisions in the Dodd-Frank, those are the emergency lending provisions in the Dodd-Frank Act, to create the Bank Term Funding Program, the BTFP. I'm sure you've all memorized this acronym already. But this program seems to be likely to be highly effective. It's doing exactly what you would need to do in this situation. You have banks that may have securities that have lost value as interest rates rise. That's what happens. But they can post those back to the Fed and borrow money against them to meet any liquidity issues that they might have. This seems like it's going to be very effective, at least in my judgment, and I think this was the right response to the current situation. Similarly, overseas, and if you did have other problems overseas, you could see other regulatory authorities coming into action, but they acted quickly to ask UBS to buy CS as a method of preventing additional fallout from the CS decline. That happened over a weekend. It was not pleasant to try to do a big merger like that over the weekend, but it can be done. And again, I think that response was appropriate. And then, as Secretary Yellen said yesterday, authorities can take more actions if necessary going forward. So I just think this is a different world than the 2007 to 2009 world where you're inventing things on the fly. Chair Bernanke had to think about new tools that had to be developed, approved by Congress perhaps. Here you have the tools in the toolbox, and you can take out the appropriate tools to fight the stress as necessary. So the last thing I want to say on financial stress is that the Fed has been raising the policy rate over the last year to combat the highest inflation in the US since the 1980s. So the inflation problem is real and is large. And I would just say anytime that you do this, even with a lot of forward guidance, and I gave some forward guidance to you guys here last year at this very meeting where I said I thought we were going to have to raise the policy rate a lot. But even with considerable forward guidance, you can't really expect every entity in the financial world to adjust appropriately to the higher interest rate environment. So here's some examples on that third bullet point. If you know monetary history of the United States, you'll remember these examples. But in each case, these examples did get a lot of attention at the time and did get a lot of response at the time, but they were not ultimately harbingers of poor macro performance in the US. So I think that's probably the kind of case that we're in now. Meanwhile, the data has been strong, stronger than expected. A lot of people were expecting a weak first quarter of 2023, but the Atlanta Fed's GDP now, which is their tracking estimate of first quarter growth, is 3.2%. So in US terms, that's a high number. That's above the potential growth rate. That comes on top of above-trend growth in the second half of 2022. So that would be 3 quarters in a row if that pans out. We've also seen strong consumption, which is associated with strong GDP growth. So here's my GDP picture. 2021, so the blue bars are the GDP growth rate at an annual rate, quarterly numbers at an annual rate. 2021, on the left-hand part of this chart, you see a lot of tall blue bars. That was just outstanding. You're coming out of the pandemic, you're getting really fast growth, 6-7% in a lot of those quarters. Then something funny happened in the first half of 2022, last year. You got negative growth in the first half. A lot of talk about that. People weren't really sure because we were still adding jobs at a rapid rate. Unemployment was still coming down. But that was below potential growth rate. And then in the second half of 2022, the two blue bars on the right-hand side, again above potential growth. A lot was said about that, too, that was surprise to the upside. And now that little dot there, which is the Atlanta Fed's GDP now, again, looks like above trend growth. So this paints a picture of an economy that's been quite resilient during the second half of 2022 and coming into 2023. So I think we have a lot more momentum than previously thought coming into this year, and that's going to make the inflation problem harder to handle. Let's go to the next slide here. Well, this is the consumption picture. So this is the level of real personal consumption expenditures. That is how many Doritos you and I are purchasing to watch the basketball tournament. So this obviously went way down during the pandemic, which is the gray bar there. This picture goes back to 2012. But if you draw a trend line from 2000 to 2019, before the pandemic, you get that dotted line there, and we're well above this dotted line. So again, you have an idea that the U.S. economy is doing quite well on many dimensions. And why is that? A lot of it is coming from the labor market, and the labor market is very strong in the United States by almost anyone's estimate. The number of job openings per unemployed worker remains very high. I'll show you a picture of that. The labor market situation is unprecedented in the sense that there seems to be a shortage of workers relative to what you would have seen during most of the post-war era. Unemployment insurance claims, extremely low. Unemployment itself, very low. If you want a broader measure of labor market conditions, like the Kansas City Fed's Labor Market Conditions Index, it remains super high. So normally what you would say is if people have jobs and they're able to get jobs, even if they get disrupted, they're able to get another job. That bodes well for consumption expenditures, the largest component of GDP. So this certainly looks very good for the economy at this point. So I've got a bunch of pictures for you here. Here's vacancies per unemployed person. This goes back to 2000. Shaded areas are recessions. But the numbers that we're seeing now are just crazy high and really haven't come down very much. So we're still, the right-hand part of this chart, we're still looking at almost 2 to 1, that is 2 job openings for every unemployed worker. So even if you hear about layoffs, with that kind of job openings ratio, the disrupted workers should be able to go and get another job if they want to, and so hopefully they're able to do that. But this is really unprecedented, this very high level here. And this is another picture meant to show that the labor market situation is unprecedented. The gold line is available jobs, which is job openings plus the employment number, and the blue line is available workers, the size of the labor force. So you can see here the blue line is usually above the gold line going back to 1980 in this picture. But wait a minute, if you look at the right-hand part of this chart, the gold line is above the blue line. So this is unprecedented almost. We had a little bit of this pre-pandemic in 2019, 2018 there in this chart. But normally, this is not the normal situation. Normally, you've got a lot of workers who are doing lengthy searches, are having trouble finding the job, that kind of thing. That's not what you have here. So this is a very different picture from what you would normally see. Why is the blue line so low? There's a good story behind that, and Chair Powell has talked about it. It has to do, and I could go into it more during the Q&A if you want, but you know, older workers not coming back into the labor force as readily as they used to, daycare not recovering as much post-pandemic as you would have otherwise thought. Immigration for a long time dampened, now has come back some, but they're just workers that aren't there, the blue line, workers that aren't there that would have been there in the past, and the gold line has moved up dramatically. So you've just got this unprecedented situation, something we haven't seen in 40 years. Here's the unemployment insurance claims picture. This shows, this is a little bit different here. This shows every week of the year on the horizontal axis. The week 1 is on the left-hand side, week 52 is on the right-hand side, and then all the different years are, that shows the number of unemployment insurance claims weekly are plotted. And you can see 2020 is a crazy pandemic year and went off the chart here. But all the other years were pretty good years for unemployment. And you can see the red dots there on the left-hand part is so far in 2023. So far in 2023, we're seeing no hint of let-up in the unemployment insurance claims. It was just very low. The number we had yesterday, below 200,000, that's just very, very low for the U.S. economy. So you just don't have a lot of people being thrown out of work and having to go collect unemployment insurance, not right now anyway. So here's a measure of overall labor market conditions. You take all kinds of different measures of the labor market and put them all into one index. The Kansas City Fed does this for us. This goes back to 2006, so you can kind of see how this looks over time. 0 is normal labor market conditions in this picture. And you can see we're basically at an all-time high, or close to an all-time high in this picture, and still super strong labor market. Okay, let's turn to inflation, and we do want inflation to come down. We have a 2% inflation target in the U.S. That inflation target is specified in terms of headline personal consumption expenditures inflation, PCE. And there's going to be a quiz later on these acronyms, so that make sure that you get them all. It's true that headline inflation has declined, but headline inflation can be affected by fluctuations in energy and food prices. If you look at measures of inflation that strip out those movements, they have declined as well, but not as much as the headline measure. So here's the picture. This is inflation as measured over the previous 12 months. This goes back before the pandemic to 2019. The blue line is headline inflation, the gold line is core inflation, and the gray line is a geeky measure, which you would expect from me being a geek, the Dallas Fed trim mean. So that one does a better job, I think, of throwing out extreme price movements either on the low side or the high side. So you can see before the pandemic in 2019, we were talking about inflation being below target or at target based on these three measures. The inflation really just started 2 years ago as the lines, in March of 2021, as the lines came off 0 or came off below 0 and went higher, and we're still trying to adjust. Now, these curves are, if you squint, are moving down on the right-hand part of this picture, and in particular, headline inflation was 7% at the peak, now maybe 5.5% on this measure, so that's good news, but it's not 2%. And we know that part of that is energy prices. If you look at the gold line, it might have peaked at 5.5%, now below 5%. Okay, that's progress, but not as much progress as you might have thought, and the latest report went in the wrong direction a little bit, so not as much disinflation as we would have liked. And if you look at the Dallas Fed trim mean measure, the gray line, it was below 4%, and you'd really have to squint to see any improvement on that particular measure. So we need these to come down to 2%, and we did put a restrictive monetary policy in place to try to get that to happen, but we're definitely looking for this data to improve as we go through 2023. Some good news for you. Inflation expectations are relatively low, so inflation expectations in the literature on macroeconomic theory, it says that inflation expectations affect actual inflation. So the way you can think of this is that if businesses are making pricing decisions, they're kind of trying to think in their head about, well, how much do you think prices will go up over the next 6 months or the next year? And then they're trying to price their product appropriately given that expectation that's in their head. But these expectations have come down because of the Fed's policy, and that bodes well for the disinflationary process in 2023. So here's another killer graph, 2 for 1 this morning on the killer graph. So this is a market-based measure of what the market thinks inflation is going to be over the next 2 years, the blue line, 5 years, the gold line, and 5 years after that, the gray line. So you can see this goes back to 2021. And the point of this is that in January of 2021, the left-hand part of this chart, markets weren't expecting basically any inflation at all. Those numbers there on the left-hand side are consistent with the 2% inflation target in these measures. Then, as inflation went up during 2021 and 2022 and started to come back down, these expectations moved a lot. The 2-year inflation expectation at one point was near 5%. The 5-year inflation expectation was near 3.5%. That's not good. Those should always be, close to 2%. But the good news is on the right-hand part of this chart, as the Fed has gotten serious and stressed that we're going to keep inflation under control, these inflation expectations have come back down under 3% and to levels that are more consistent with the Fed's inflation target of 2%. So this bodes well for disinflation in 2023. So I have one more point to make and I'll get out of here. It's true that the financial stress can be harrowing. Things happen very quickly. The information is flying around in financial markets. But financial stress also reduces the level of interest rates typically, and lower rates in turn tend to be a bullish factor for the macroeconomy. So during the current stress, the 10-year Treasury yield has actually declined. Despite our hawkish stance and our hawkish setting, the 10-year has actually declined by about 50 basis points, and the 2-year Treasury yield has declined by about 100 basis points. So there is some self-correction going on here that this would mitigate some of the negative macroeconomic fallout that might otherwise occur in the aftermath of a period of financial stress. So there's kind of a natural mechanism at play here. And here's the chart. This is daily data on yields. The 2-year yield is the blue line, and the 10-year yield is the gold line here. And you can see we were going along from January to March. But then with the Silicon Valley Bank run, financial stress ensued and rates went down. So in particular, the 10-year is a real benchmark yield, and it's down about 50 basis points. So that might help us a little bit going forward. So a little bit of a silver lining. Okay, so what did I say? Certainly financial stress has increased in recent days. I do think that the macro-prudential response has been swift and appropriate, and regulators stand ready to take additional action if necessary. In the meantime, incoming macroeconomic data have been stronger than expected. Inflation remains too high. FOMC policy during the last year has been very good and has kept market-based measures of inflation expectations relatively low. That should feed through to actual inflation during 2023. So let's hope that that occurs. And continued appropriate macroprudential policy can contain financial stress, while at the same time appropriate monetary policy can continue to put downward pressure on inflation. Thanks very much. Thanks for coming out this morning, and I appreciate your attention during this talk. Thank you.
Please welcome Consumer and Banking Vice Chair at U.S. Bank, Tim Welsh.
Hey.
Great comments. Thank you. Thank you so much. Great to be with all of you. As Jason had mentioned in his very generous comments earlier, my name is Tim Welsh. I'm the Vice Chair of Consumer and Business Banking at U.S. Bank. I'm also the board chair of Greater MSP, which is a sister organization to Greater St. Louis, and we are, U.S. Bank, are proud members of GSL. Honored to be with you today, and very honored, President Bullard, to have a chance to chat with you a little bit about this. So I want to pick up on many of the themes that you talked about. First of all, inflation. And it sounded like in your comments, you're feeling quite optimistic about the progress we're making on inflation, but more to do. And I wonder if you could just remind all of us how you think of progress. What do you think, where are the goals? Remind us of where we're trying to get to, and what are some of the things that you feel like are working right now, and any areas of concern that you have in the inflation front?
So we do have a mandate legislated by Congress and the President to maintain stable prices for the U.S. economy. That's in the law. We've defined stable prices as 2% inflation. That's an international standard that was developed in the 1990s. I think it would be a disaster to abandon that standard. That would set all the other countries to abandon their standards, and we'd be back to the 1970s. So we don't want to do that. We want to stick to our 2% goal. We have told people that we want, and that's based on headline PC inflation. So that was one of the lines in the picture there. That has come down from high levels, but I'm a little concerned that some of that decline, or a lot of it, probably came from energy price changes, and that can be kind of volatile. So you don't want to live and die on international commodity markets on this. So that's why we look at the other measures as well. They have come down some, but not as much, and so we need those to improve in the quarters ahead. I think they will in response to our policy. So, but we just don't have the data in hand yet on that. That's where we are in the mandate.
That's where we're going. Great, thank you. Now, one of the other topics you talked upon, obviously touched on, which is closely related to inflation, which is wages and jobs. And we're seeing as you highlighted, a very strong labor market. We talk to, and I know you talk to businesses all the time, facing challenges with finding new talent. How do you think this labor situation works out? I mean, you highlighted the fact that there are fewer people, for example, in the labor force. Project a little bit forward. Where do you want inflation, or excuse me, where do you expect unemployment to go, and how do we help all these businesses find the people they need to grow?
Yeah, I mean, my read of it is, for many, I've talked to many of you, but businesses are still scrambling, I would say, for workers. But being good business people, they also have other ideas about what they might do. One is to substitute capital for labor, more automation, realign their business processes so they don't need quite as many people. I think that kind of thing is occurring. I think, they get more inventive about compensation plans for people, redesign jobs so that they can attract workers. I think that's happening. And I think the supply situation is changing some. Immigration is up from where it was, so that's helping a little bit. I think that older people may become somewhat more comfortable coming back into the workforce, so you may see that dimension changing somewhat going forward. So there a lot of things can happen here, but markets will adjust. It's just not going to happen very quickly, I think.
And I'd love if you could just elaborate a little bit more on that, because one of the things that we're seeing too is people learning new skills, for example, to be able to adapt to the changing environment. You talked about businesses adapting themselves. I think you're describing a quite resilient economy that, when faced with these kinds of challenges, continues to adapt. Is that generally your perception, that both individuals and businesses are continuing to adapt very rapidly?
Yeah, I think they are, and certainly this capital for labor kind of idea, a lot of companies have ideas about, we could automate and we could buy this expensive machine and then we wouldn't need as many workers. And then they didn't do it, and they put that idea on the shelf, but now they're dusting it off.
Right.
You say, well, it's so hard to get workers now, maybe now's the time to bite the bullet and go ahead and try to implement this new process. So I do hear stories about that, and that's overall good for the economy. There's no reason to have people doing the work if you can automate it, and then those people can get higher skills and maybe reallocate into higher paying jobs. So ideally, that's the way this would work.
Fantastic. Now, I want to pick up on the financial markets and the banking sector that you touched upon. People have obviously been reading the headlines the last few weeks. And I think one of the issues with the banks that you had alluded to is people are concerned that there may be deeper, more structural challenges in the banking system. What are you seeing? Are there those challenges? And do you believe we're in a position to address whatever concerns there may be?
Yeah, as Chair Paul said at the press conference, the U.S. banking system remains very strong and very resilient. I would just amplify that if you look at the banking sector by the numbers, it's really in very good shape. So I think, it's something like SVB happens, which is very unanticipated, I think, even by the executives at SVB. And this was not sort of widely known, and it was very sudden. Of course, that's going to create angst and make everybody look at their business plans and make investors reassess, and that's appropriate, and that's what has happened. But I think we have the tools to handle. I think it was a quirky situation, and I also think that we have the tools to handle any fallout from it. So, and I think we've implemented one tool, which is the bank term lending program, which I think will be very successful in handling any immediate problems that occur.
It's great to hear that confidence that you express. Now, I'm cognizant, I'd like to shift a little bit to the fact that we're part of a GSL event here. I'm obviously very passionate about Minneapolis as well. You spend a lot of time, I know, thinking about regions and local economies. What are some of the things that you see and you suggest that places like Minneapolis, St. Louis need to do to keep themselves vibrant? Are there ideas that you've seen in the research of things other cities are doing well, anything that you'd highlight in either of these cities? But how do we keep ourselves sort of at the cutting edge so that we can continue to have a vibrant and inclusive economy?
Well, one thing, I think it's really great to have a group like this, and I think all cities should have a group that's thinking strategically for the region, trying to think about good things, what are the strengths, what are the things that we can, the areas that we can likely succeed going forward, how can we get good things to happen. So I think that's very important. I do think that the Midwest has clear advantages in the current environment as compared to the coast, which have become very expensive. Some of you know that a few years ago I did a study of per capita income by metropolitan statistical area. At the time, there were 53 large metropolitan statistical areas in the U.S. The question I asked is, which ones of these have the highest per capita income? Because as a macroeconomist, that's the kind of thing I want to talk about and focus on. And you have to take account of the cost of living in these various places. You may get a higher paying job in some cities, but then that gets eaten away because the cost of living is so high in various places. So in that study, St. Louis came out number 7 out of the 53. Minneapolis also in the top 10 out of the 53 big metropolitan statistical areas. Very large cities like New York, Chicago, and Los Angeles trailed. And even cities that sometimes get a lot of kudos like Atlanta, Indianapolis, Pittsburgh often gets credited. Not that they haven't done good things in those places, but per capita income is lower in those places. Dallas, lower in those places than Minneapolis or St. Louis. Also in that study, the place to watch, and you guys all know this, Nashville, Tennessee, absolute boomtown, and seems to continue to be a boomtown. So that's one to look at and think about, because if you just look on a map, it doesn't look like that's going to be the place that's going to be the hot place, but it has been for the last 10 to 15 years. So they're doing something right over there.
Clearly are.
Yeah.
I want to, sometimes when people look at studies like that, they can say, well, the averages may be good, but there can be a lot of dispersion in that. And one of the things I think was interesting about your study is that you found that in places like St. Louis, Minneapolis, that there is actually less inequality in some of those places.
Yeah.
So I wonder if you could talk about the inequality as
Right,
well.
so if you want to move to a place that has less income inequality, it would be places in the Midwest like Minneapolis or St. Louis. The other places on the coast and the very largest cities, that's where a lot of the inequality is located. It makes a lot of sense. You have a place like New York City will attract very wealthy people, and maybe from foreign countries as well, but also have a large group of very poor people, so their inequality is super high. We don't have as much of that, so we don't get that kind of inequality. Not that we don't have issues. All cities have issues, but it's not as high or as rampant, let's say, as it is in some of the coastal cities.
Well, it's great to see that in the Midwest we're doing a lot of things well.
Yeah.
Thank you for those insights. It's been a real joy to hear you today. Thank you for your comments to this group. I want to particularly thank Jason and GSL for hosting this event. Congratulations, by the way, on the amazing success of GSL in the first couple of years. It's really remarkable to see. We're grateful to be partners. Thank you all for being here. We're delighted to host this event. And thank you again, President Bullard, for your comments today.
Great. Thanks so much.
Thanks.
That was super.